All right, our last chapter here in chapter 17 is looking at tools we can use to analyze these financial reports we've learned how to prepare, right, over the course. So there's a couple different tools. We think of them in two different sets. We've got ratio analysis, which uses independent or different numbers that have relationships to one another in the financial statements and compares them to each other. And then we also have horizontal and vertical analysis. This first problem is focusing on horizontal and vertical analysis, but we are going to do one quick ratio. Okay, so we can kind of see the difference from a kind of a macro perspective. So let's start with what are we working on here. Well, we have some financial statement information for Bluegrass Corporation. Okay. So they've given us comparative year-end balance sheets, and we can see they're summarized, right? So this is kind of summarizing all the current assets into one amount. Kind of same thing down here. They've done a lot of summarizing, condensing, and they've given us 3 years worth of balance sheets. We also have 3 years worth of income statements down here for the same company. Okay. First thing they want us to do is compute each year's current ratio. Right, so to calculate the current ratio, the formula is to take the dollar amount of current assets and divide by the dollar amount of current liabilities. Okay. So if we take the current assets for 2021, which are 54,860, and we divide by the liabilities, current liabilities at the end of 2021, we come up with a number 2.5. Okay, what we're saying is that current assets are 2.5, 2.5 times the amount of current liabilities. So we call it a ratio of 2.5 to 1. Right? For every dollar in current liabilities, we have $2.5 in current assets. We can do this for 2020. Current assets divided by current liabilities. Okay. Here they are 1.7 to 1. For every dollar in current liabilities, we have 1.7 in current assets. And then this last year, current assets of 36.3 divided by current liabilities of 16.5, a ratio of 2.2 to 1. For every dollar in current liabilities, we have $2 or 2.2 times in current assets. Now, clearly we would want to see current assets exceeding current liabilities. So given the fact that all 3 years the company's current ratio was greater than 1, it's indicative of a good financial position. If this assets were less than the current liabilities, then we would be a little bit more concerned because that would indicate the company didn't have enough assets available to pay its current liabilities. Right, so that's one way we can analyze reports. We can take two numbers that have some sort of relationship to one another and compare them through ratios. Another way we can do it is to do vertical analysis. Okay? And sometimes it's called common size analysis. And in vertical analysis, we are kind of comparing line items on a financial statement to one another within a year. So we're kind of going vertically up and down within that same year. Okay, so what they're asking us to do is for the income statement, do a common size or a vertical analysis. The way we do that is we look at some base amount, right? We have to establish one amount that is the baseline for all other items. And in an income statement, what we're going to use is revenues or sales as our baseline amount. And that baseline amount is what we're going to compare every line item in the income statement to. So for sales of 198, it's a little bit bigger. For sales of 198.8, 198,800 divided by 198,800, sales are 100% of sales. All right, so kind of making sense? Hang in there. Cost of goods sold. If I divide the amount of cost of goods sold by the base amount, 198.8, my revenues. 108,890 divided by 198,800 Cost of goods sold are 54.77% of total sales. Gross profit, 89,910 divided by sales of 198.8. Gross profit is 45% of total sales. Okay, so you can see what I'm doing is I'm taking each line item and dividing it by the amount of sales. All of these are percentages. This is telling me what each line item on the income statement is as a percent of sales. I'm going vertically within the year. I'm going to do the same thing for 2020. Sales is my base amount. I'm going to divide cost of goods sold by sales. Cost of goods sold is 51.91% of total sales. Gross profit divided by total sales, 48.9% of sales. Selling expenses divided by total sales, 11.92%. Again, I'm taking each line item within 2020 and dividing it by 2020 revenues. Do the same thing for 2019. Each line item as a percent of 2019's revenues. Coming up with a percentage of each line item of total sales. So in vertical analysis, I'm going vertically within that year and comparing each line item to the base amount. What does this do for me? Well, essentially I can start looking now across the years, and I can see that cost of goods sold has been steadily increasing as a percentage of my revenues, which results in a gross profit decreasing over time. Okay, so I'm seeing a trend that probably isn't good for the company, because we would prefer to see a higher percentage of our revenues remaining after subtracting cost of goods sold. Okay, we can see trends. It looks like our selling expenses are trending down. Admin expenses are trending down. Okay, so total expenses are trending down in the operating activities area. Okay, so I can see that overall my net income as a percentage of my revenues has decreased over the years. And now I can go back and look and say, well, I removed the dollar amount. So it's easier for me to see what's causing that decrease in net income as a percentage of our sales. All of my other expenses were improving over time, but my cost of goods sold was increasing over time. So if I really want to improve my profitability on my revenues, I need to focus on figuring out why the cost of the inventory that I'm selling is going up as a percentage of sales. Okay, so the benefit of using these tools is it takes away the dollar amounts, which can kind of make our eyes not really be able to zero in on what's really going on, and using percentages, a little bit easier to analyze. Okay. Another thing that we can do is do horizontal analysis. Okay, and in the difference between what we just did, vertical analysis, which was analyzing vertically within a year, horizontal analysis is going to analyze across years. So the requirement 3 is having us express the balance sheet data in terms of trend percent. So we're going across years horizontally. So going up here, I can see that I have my balance sheets for every year. And what I want to do is go horizontally across the years. Current assets. I want to look at what the change is over time. And the first year I have available to work with, my base year is 2019. So all of my horizontal trends are going to be based off of 2019. So if I divide 2020 current assets by 2019 current assets, 32,660 divided by 36,3, current assets in 2020 are roughly 89.97% of what they were in 2019. But then in 2021, current assets of 54,860 divided by my base year amount. Current assets were 151% of what they were in my base year, 2019. Okay. So what we're doing is we're establishing 2019 as the base year and calculating a change from year to year based off of that base year. For example, long-term investments, 10,600 in 2019. In 2020, they were 1,700. So 1,700 divided by the base year, long-term investments were only 16% of what they were in 2019. In 2021, my long-term investments were 0. Right? So they're 0% of what they were in 2019. Planned assets. Divide 2020's amount by 2019 base year. Planned assets were 144% of what they were in 2019. In 2021, 112,810 divided by 79,000. My planned assets were 142.8% of what they were in 2019. Okay, so again, look at what we're doing is we're analyzing across the years, horizontally across the years, as opposed to when we did the income statement, the vertical analysis, common size analysis, it was all within that year. Okay. So let's take a look at another problem that has us working with more of the ratios that I referred to in that first problem. Pulling up the summary in your textbook. This is exhibit 17.16, okay? And this really shows you all of the different ratios that we're gonna work with. So I will toggle back and forth a little bit as we're working on this problem. Okay. Let me pull back up the problems. All right, so what they've given us here is some information for, actually let me get the right company up here, Overton Company. And we're going to go through some analysis using ratios. Okay. So they also gave us some additional beginning information about assets, common stock, retained earnings, which we'll need for some of the ratios. But an income statement, balance sheet for this year, and they're going to ask us to calculate a series of ratios. Okay. First ratio they're asking us to calculate is the current ratio. Okay, so going to the current ratio, we can see, just like we did in the previous problem, we're going to divide current assets by current liabilities. Going back to our example here, current assets, I'm going to find that down here in my asset section. But of course, they didn't give us the easy balance sheet, right? They gave us a balance sheet that is not broken into current and long term. So we're going to need to remember what is current and long term. And pretty much all of these assets, except for long-term property, plant, and equipment, are all going to be current. So what the problem is doing is adding up all of our current assets, which is cash, investments, accounts receivable, inventory, prepaid expenses, and we're going to divide by our current liabilities. Accounts payable, accrued wages payable, and income taxes payable. Okay, that tells me that one's long-term, so that's not a current liability. If I take my total assets, divide by my total current liabilities, I come up with a ratio of 2.5 to 1. Healthy, but it'd be more informational if I could then take this and compare it to either prior year or maybe what the current ratio is of my competitor. Acid test ratio. Acid test ratio. Cash, short-term investments, current receivables divided by current liabilities. Going back to, here I can see here I was my cash, short-term investments, accounts receivable, divide by my current liabilities. Come up with 1.6 to 1. Again, I think that's pretty good, but until I have something to compare it to, either prior year or to a competitor, it's not really telling me a whole lot, right? The analysis really continues and really gets important when we're done calculating the ratios. Continuing on, days sales uncollected, accounts receivable divided by net sales, and then multiply by 365. Accounts receivable is 15.1. I'm going to divide by my sales of 315.5, multiply by 365. On average, I have accounts receivable uncollected for 17.5 days, right? In other words, I wait approximately 17.5 days to collect my sales. Okay. What you're starting to see is that calculating ratios is really about taking the formula and plugging in some numbers. Okay, the calculation of these ratios is not hard. Now that you've worked with these financial statements for a while, you know where you can find this information within the reports. Okay. Ratio analysis really becomes informative when we start interpreting what it's telling us. Okay. Are these good ratios or not? I mean, they look pretty good to me, but again, is this an improvement over last year, or is things gotten worse from last year, right? That's where the analysis really becomes beneficial and important. Okay. Continuing on, inventory turnover is calculated by taking the cost of goods sold and dividing by the average amount of inventory. All right, cost of goods sold, I'm going to find that on the income statement, 236.1. I need to divide by the average inventory. Okay, well, the inventory that's reported on the balance sheet is just the end of the year. That doesn't tell me what the average was during the year. So the best way we can come up with a rough average is to take the beginning of the year inventory, told us that was 17.4, add it to the end of year inventory balance, 13.5, and divide by 2. When I calculate that, I come up with an inventory turnover of 15.3 times. Their inventory is bought, sold, turned over roughly 15 times a year. I think it's pretty good. Right? We can continue on with our analysis of inventory by determining the number of days the sales sits in inventory. Ending inventory amount divided by cost of goods sold multiplied by 365. All right, cost of goods sold is 236.1. Ending inventory is 13.5. Divide ending inventory by cost of goods sold, multiply it by 365. On average, inventory sits roughly 21 days before it is sold. Okay. Continuing on, debt to equity. Debt to equity ratio, now we're going to look at solvency, or the company's long-term ability to continue existing. Total liabilities divided by total assets. The current ratio only focuses on current assets and current liabilities, but the debt to equity ratio is going to take total liabilities and total assets. So total assets, which they kind of broke out here a little bit, but if we divide total liabilities by total assets, we end up with 0.68 to 1. Times interest earned is going to be income before our interest expense and taxes, and divided by the interest expense. Let's see, our income before income tax and interest would be the $28,000 plus the interest expense of $2,200 plus the income tax expense. Excuse me, sorry, just the income before interest expense. This is already before income tax expense. So we added the interest back to get income before interest and taxes, and then divide by the amount of interest. income exceeded interest by 13.7 times. Profit margin ratio, net income divided by net sales. Profit margin is going to be our net income of 23.8 divided by total sales of 315.5, 7.5%. Income is 7.5% of the sales. Total asset turnover is going to be the net income divided by our average total assets. So total revenues divided by average assets, our total sales at 315.5. And to get our average assets, we take our beginning assets plus our ending assets and divide by 2. 3 times. In other words, income was 3 times the amount of investment in assets. A return on assets is going to be the amount of net income divided by average assets. Net income of 23.8 divided by our average assets, 22%. Oops, did not mean to do that. Sorry about that. In other words, our net income is 22% of the amount we have invested. And return on equity is going to be net income divided by our average total equity. So our net income of 23.8 and divide by our average equity. So we ended the year with equity of, 35,000 plus 35.1 or 70,100. Our beginning equity was common stock plus retained earnings, and then divide by 2 to get the average. 38.3% return on equity. Again, what you're seeing is that the calculation of the ratios is the easy part. It's about finding the information within the financial reports. All of these results that we have received, it's hard in the educational setting to really interpret them, because to interpret them, we need to be able to compare them to something, whether it's comparing it to prior year or to current years from other companies, right, to see how our competitors are doing. All right, hopefully that helps with chapter 17.